Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our money, our finance, and our retirement future. He is president and founder of McIntire Retirement Services, Chris McIntire, your personal resource, ladies and gentlemen. If you would like to get financial questions answered, if you'd like to get planning matters addressed, pick up the phone and give Chris a call at 800-868-1194. That's 800-868-1194. On today's program, going to be addressing, unfortunately, what we have seen all too often commonly made financial mistakes. What are some of the common financial mistakes? And Chris, I am certain that you do, unfortunately, see a little too many of these when you're talking with folks.
Yeah, we're all human beings, and who hasn't made a financial mistake? You know, I was out of boating and I got back in. That would be my biggest financial mistake right now. And to add some humor to the topic here, but very serious topic here, of course. And, a lot of folks, there are a lot of mistakes you can make. It's a very, the world that we live in, Peter, is not cut and dry. It's this is right, this is wrong. This is the best stock in the world. This is the worst stock in the world. It's just not quite that simple. But, there are some things you can try to stay away from and, probably making those emotional decisions. Had a conversation with somebody not all that long ago and said, I really need to be doing something different here. He said, but I just can't make myself do it. I need somebody like you to not have the emotions and whatnot that I do on, how do I get in? How do I get out? That type of thing. So, sometimes that's the role we play, almost like a psychologist, if you will.
Absolutely. Well, I think, Chris, we probably, if we really thought about it, all have a laundry list of things that we have maybe regretted or done wrong or woulda, coulda, shoulda, but we didn't. And hindsight often said to be 2020. Really looking back, it could be a little bit better than that. Even we should have gotten into that fund at a certain time. We should have sold out of that stock at a certain time. And with the benefit of hindsight and history, those kind of decisions are obvious. They are so clear, but we only know what we know in the moment. We don't have the benefit of seeing the future, but we still look back and say, well, that was a mistake not to have done X at this time. Really, the only mistake there, Chris, is maybe not acting on things that we should know or do know that we should be doing.
Yeah, exactly. And, some folks have made fortunes on Bitcoin. Some folks have lost fortunes on Bitcoin. That's probably an example of, a hot commodity, if you will. And, it certainly had its tough way to go here. Some of those blockchain technologies here to start 2022 anyway, in trying to, you and I have said on the radio show how many times, Peter, so look, we build well-constructed, well-diversified portfolios around our clients' risk tolerances. And, so we have to manage that risk tolerance sometimes more than we manage their assets, if you will, because, you get 3 bad days in the stock market or, kind of take January, certainly had a pretty big tug of war going on there with the way the markets were performing. And, you get an email from a client, hey, should we get out? It's like, all right, but when do you get back in? Because the markets can turn and, you need to ride through these things. And that's why you build well-diversified portfolios. It's why you have a safe money strategy that we advocate, especially for those that are already retired or just about ready to retire. And, one of those human emotions is greed, obviously. I think we'll call that an emotion. And, as the market is going up, people want to stay in. I don't want to get out just yet. And then it turns. They're like, well, wait a minute. Once it gets back to where it was, then I'll get back out. Like, all right, well, tell me the day that's going to happen, So you're worried about 1% here when your portfolio was up 27. You're worried about 1%. Seriously.
Yep. Well, beating ourselves up for what we didn't know, trying to time the market, a few of the unfortunately too common financial mistakes, but maybe the number one, Chris, you've got a great list here. Simply not saving enough. We need to be saving throughout the course of our lifetime because we trade our time for money. And at some point in time, we want to stop being forced to make that trade. So the age old question, how much is enough? Chris, we all need to be striving to save as much as possible, but at the same time, being able to enjoy life along the way takes some discipline too.
Sure. And, and sometimes that's the role that I play for folks is, look, it's okay to spend a little money here, guys. You've done well. We made it through 2020. We had a good year in 2021. This is the time. If you need something, let's take some gains off now and go buy what you want to get. If you want a little extras, the trip or whatever. And obviously in a COVID world, some of these things have checked that, if you will. But, and I know even for myself, I've got my little personal account that I keep, and it's like, boy, now that it's got a level in it, I don't want to spend any of it. I love having that little cushion in there. It's like, well, it's there to spend, but I still like having that cushion.
Yeah. It's funny. We all have that kind of earmarked amount that makes us comfortable in the bank account or the checking or the savings. And then if it levels up, that sort of becomes our new comfort level. And we don't like to see it go back down below that.
Yeah, you're absolutely right. All of a sudden emotion takes place here. And, I bought my wife a nice Christmas present here that she would have never bought herself. And she had to write the check to pay for it, obviously, because she handles the books in our house. And she's like, yeah, that was a nice Christmas gift, wasn't it? And she would never spend anything like that on herself. So,
but yeah. Chris, without having a plan in place that helps us feel confident that we are saving enough, being afraid to spend may be the natural progression and result of that. We got to have the plan in order to have that balance or sense of balance about the progress that we're making and the enjoyment that we can experience along the way.
Yeah, I budgeted to spend $7,000 a month. We were only spending $5,000. We've got an extra little cushion here. It's okay.
Absolutely.
But like you say, Peter, it's important to monitor along the way because we had a good year in 2021 as far as the markets are. Had a good year in 2020 as far as the markets went for most folks. And 2021 had a good year. That doesn't mean 2022 is going to be a good year. You can't set your expectations on what happened in the past. The future is the unknown. And you have to have the ability to adjust that portfolio. It might end up being a year where, hey, the markets are negative over the course of 2022 because of the rising interest rates and the tug of war on inflation, and people stop spending more money and drives the markets down, hurts your 401k, and you're a little more reluctant to spend. So, for some folks who are just now retiring, they had a good year in the market. Maybe they end up with a tough year in the market, and they learn to condition themselves, right? With age comes wisdom, A lot of people are smart, but wisdom is what gets you through because wisdom means you've got some experience.
Common mistake number 4, making decisions based on past performance is what you're touching on there, Chris. The market was great last year, so obviously it's going to do the same this year. Not necessarily the correct conclusion there. We need to make our decisions not based on that past performance. And kind of 4B, Chris, here is average rate of return. A lot of people sort of look at the list of funds that they have the options to choose from, to pick in their 401k, for example, in their investment portfolio, and base the decision on a stated previous return. Not always the best indicator of what is the best fund for us and our goals, or what we can expect for the returns to be in the future.
Yeah. And I think you and I have gone through this a number of times. I say it a lot in our education events that we host around Northwest Ohio is, an average return, let's go through an average return, Peter. You have $100,000 and you have a terrible first year and you lose 50%. How much money do you have?
50,000.
Okay. And then next year, the market rebounds 50%. Okay. You left your money in there and it rebounded 50%. How much money do you have?
We are not back up to the 100,000 though.
Nope, about 75,000.
75,000.
Yep, made 50% on 50,000. And then the next year, the market made about 33%. So now you're back at $100,000. That's an 11% average rate of return. And you don't have anything extra you don't have 11% extra money from when you started.
3 years, average rate of return, 11%, and you have no profit whatsoever. And that's before fees and costs and expenses too, Chris.
Correct. Yep. That's an average rate of return. So your real rate of return was 0.
Yep. And it's funny how that difference is not reflected in the choice that we make when we see that past performance of the fund. They base it off of the linear average that you just went through. They'll tell you it's an 11%. They won't say, hey, over a 3-year period, that 11% rate of return netted you a 0 profit.
Yeah, it would be weird if they showed you a graph of what your money did and where it is, and then the average rate of return on another statistical chart.
It may make a few different decisions when we're looking at our money. And ladies and gentlemen, if you want to learn a little bit more about the common financial mistakes that are made and avoid those mistakes, that's the point, is we don't want you to fall for some of these mistakes or fall into any of these mistakes. Give a call, Chris McIntire, your resource. He can help make sure that your plan is sound, solid, structured in a way that makes sense to work to achieve your goals. 800-868-1194. That's 800-868-1194. Number 6 on your list here, Chris, taking too much risk. And a lot of people are probably doing that right now.
Well, and that's that greed factor we talked about. And in a 0% interest rate environment, where are you supposed to put your money? You're going to, bonds have been a very dismal performing asset class. And then, stocks have done incredibly well. So why put it in something that's doing absolutely nothing when the market had been doing very, very well? And it's a cautionary tale that you need to tell folks here. Say, you can diversify and look at gold and real estate and some other pieces like that. Not always just stocks. That here in the month of January has certainly been a tough month for those who were in the equity side of things. No question about it.
Although, Chris, on the other side of that, another mistake, not taking enough risk. Now, for some reason, we've been taught that risk equals growth, risk equals progress, not necessarily. Risk equals risk. And so we've got to weigh that carefully. But we can't just keep our money sitting in a bank and expect to make the progress that we need our money to make for us.
Yeah, you're absolutely right. In fact, you're losing purchasing power with that money that's sitting in the bank account right now, for sure. And and where do you put that to work to keep pace with inflation so that your dollar buys the same thing next year that it did this year? And, we're going to be having this discussion here at least for the next year, if not longer, as in inflation seems to be going to run above its historical average. I'll say that anyway, of 2%. We're probably in that 7% range right now. And no real end to that in sight just yet until maybe the economy has to slow down a little bit, and companies will be, they're going to raise their prices as long as they're selling goods on the shelves, right? That's capitalism.
Right. Yeah. I don't see any large incentive for this transitory inflation to recede, to go away, for prices to come back down and correct, Chris. Why? Because people are still buying things. People are still paying these prices. What's the incentive for them to lower those prices if people are still paying what they are asking now?
Yeah, correct. There isn't any, and I think as we work our way into 2022, let's hope that we get the virus behind us. We get a more normalized economy, especially the supply chain issue there. And then competition can come back into play, and maybe the pricing mechanisms will not be increasing nearly as much as they were. I can't speak to oil because who knows, we used to be energy dependent, and for some reason we are not now.
Chris, next on the list, kind of a subcategory here, not rebalancing on an ongoing basis. This is something that's actually going to help us control the amount of risk that we are taking.
Absolutely. And I think, like we've spoken on previous radio shows, is if you're in a 50% stock, 50% bond portfolio, to keep it simple, and the stock market returns 20% and the bond market returns 3%. Now you have a lot more money in stocks than you do bonds, and which can be good if the market runs up. But again, to balance your portfolio, you need to keep those allocations 50-50. And that's, a lot of the things that we do for our clients is rebalancing their core portfolios on a quarterly basis to make sure we're staying within that risk tolerance threshold that we had measured with them.
Well, updating that risk tolerance on an ongoing basis important as well, ladies and gentlemen, because Chris, our risk tolerance is actually going to shift and change. So not only just rebalancing back to the previous risk tolerance, but actually reassessing what that risk tolerance level is periodically.
Yeah, absolutely. And that does change over time, right? In a red hot stock market, everybody's a bull. You get a couple of bad weeks and all of a sudden the bears come out to play. And, and that is the job of a financial advisor is to, I'm going to call it an investment advisor because that's the term that we use that describes us is, understanding how that client behaves in different times and having the ability to work within those range of expectations. And sometimes that's easy. And sometimes you need to, have some tough conversations saying, look, this is what we talked about. This is what, when times were tough, this is what you wanted to do. And that's why we did what we did. And you have to bring up those conversations, buddy.
Talking today with Chris McIntire, president and founder of McIntire Retirement Services, discussing, unfortunately, some of the common financial mistakes that people make. And we are discussing this, ladies and gentlemen, so that you can learn and hopefully avoid many of these. And if you are perhaps making some of these mistakes, that you can understand what it takes to correct them and then move forward and making financial progress. Chris McIntire can help you put that plan together, can help you review and update a current plan, the risks that you're taking, the fees that you're paying, the taxes that you will be liable for, all part of that complimentary review and retirement planning strategy session. If you'd like to take advantage, pick up the phone, give a call, 800-868-1194. That's 800-868-1194. Perhaps the biggest mistake of all, Chris, is not looking forward, not properly planning for the future and for retirement, living just for today.
Yeah, no question about it. You have to look into the future here and kind of see where things are going to be. And, we did a previous radio show. We were talking about, long-term care expenses. And so if you're 60, 65 years old today and healthy, this is when you need to plan for things that are going to happen down the road and get yourself some protection from a $100,000 bill at the nursing home, that can go on for, 3, 5, 7 years for crying out loud. And, whose money do you want to use to pay for that? Yours or an insurance company's?
Yeah.
And it isn't certainly an area that a lot of people don't want to talk about. They don't want to address it. They're like, we'll probably be okay. None of my parents went into the nursing home, and that can play a factor in that decision as well. And most people that have some form of long-term care protection, myself included, have cared for someone who's in a nursing home now.
If you've experienced it firsthand, you're more likely to take it seriously, understand the implications, and then do some planning for it. But I think you're right, Chris, is unfortunately too many of us feel as though we are never going to experience it, want to believe or convince ourselves of that. And that's just one of the areas where we are not accounting for Murphy and Murphy's Law and the fact that what can go wrong might or will into the future. Way too many plans, Chris, really have kind of optimal assumptions that everything is just going to work out, that we're going to make an 8 or a 10% rate of return into the future. We're only going to need 4% cash flow and income. That's going to remain the same. Inflation's not going to be a factor. We're not going to have those kind of expenses medically at any point in our life. And that really is not planning. When you're putting the plan together, you're sort of poking holes in some of those assumptions.
Yeah, hope and prayer portfolios aren't going to cut it in the real world, guys. Reality, life is what happens to plans, and reality can certainly, set you back and put things in perspective. It just had that conversation with a client that had a very bad case of COVID, at age 63. And he's like, look, this has really made me look at things certainly a little bit differently. And, he lives by himself. and his son was in college and had to come home and help take care of him. And, there's a guy that was vaccinated, did everything right, lives a healthy lifestyle, and it rocked his world for sure.
Well, we need to make sure that we've got a plan in place that does account for the what ifs in life, and in certain aspects and in certain considerations, Murphy's Law, what can go wrong will. If you take the planning process approach that we're taking negative assumptions and you are prepared for them, the plan still works. How much additional confidence does that give you actually moving through life with that plan in place, Chris?
Oh man, it just breeds confidence, or it breeds reality in some people's, retirement aspect that we do for them, or the retirement planning we do for them is, put things in our software program, run the Social Security analyzer, review the pension options. It's nice. You'll get an email like, boy, after talking to you, we feel so much better about our retirement. Or, sometimes you get ones like, look, thanks for pointing that out. I think we're going to work for a couple more years here and help build our retirement savings. We saw where the weaknesses were, and a lot of folks, one of the big things is, are you going to stay in your home in your retirement, or are you going to downsize 5 years, 10 years down the road? And, what do you think you're going to move into? You're going to change states and different things like that. Are you going to relocate near children or where the grandkids are, right? They don't move close to the kids. They move close to the grandkids. Who can blame them, right?
Chris, number 11 on the list, focusing on the lump sum, not looking at retirement as an income issue. Why is this so important? And why, unfortunately, is this so common?
Well, I think the number one concern for people is, am I going to have enough money to live on? Am I going to run out of money? And I would say, we've talked on the show here, Peter, for years, is running out of money and running out of income are two different equations. You might not have anything left in your 401k account, but, is your pension payment or your annuity payment still giving you $4,000 a month or whatever it is, and you can live off of that? Because if you think of it, about everybody listening to the show today that is working, is living off their wages, not out of their 401k. For those that are retired, they might be pulling some money out of their 401k. And most of them will tell you that was a very emotional, element that they had to deal with something they had been putting money into for 30 years. All of a sudden, now they're taking money out of that and much more conscious about the risk and the volatility, that the stock market can perform on that portfolio. And that's why we advocate safe money.
Yeah. And yet, Chris, we seem to have a focus. We've been trained. It's been ingrained in us that we need to look at that lump sum as the metric for retirement readiness.
Yeah, no question about it. And, if you have that pension payment that's available from the company you live with, or they're going to write you a big check that you can roll over into your IRA, how do you structure that pension payment or that pension rollover? Which one makes sense for you to take? And we help a lot of people through that.
Chris, that's a big decision with big implications. Do you take the income? Do you have the lump sum? But at its core, as number 11 on your list indicates here, retirement is an income issue. So even if we have that lump sum, we still have to figure out how to create income from it.
Yeah, we certainly do. And, do you buy dividend paying stocks? Do you look for bond portfolios? Do you look at real estate? Do you look at, just growth stocks, the market to go up? Do you look at an annuity that can give you an income, a joint income for life if you're married, of course? And then how do you, have your income adjust for the cost of living adjustments? Like now dealing with inflation, it's kind of been the key concepts we've been having in our client reviews is, look, is everything going okay? Everything's costing more. And, most folks right now that we're dealing with that are retired have a pretty big cash cushion from stimulus checks that have been sent to them, or, not traveling a lot. So I think there is a lot of cash cushion right now, and people are just burning through some savings to make up the difference. But at some point, with as expensive as everything is, they're going to burn through that cash cushion, and the Social Security payments aren't going to keep up with what they're spending. And, where do you, how do we make some adjustments? Do we turn on annuities? Do we, start taking the dividends instead of reinvesting in them? And, that's where having assets in different places that do different functions for you can certainly should provide you some peace of mind and, and help improve that quality of life that you deserve so much.
Next on your list, Chris, of common financial mistakes. You've touched on it: income and Social Security, not making an optimal choice with Social Security. Oftentimes, we just go out and claim and collect without thinking through all the choices and options. We see that too much.
Yeah, very much so. I took early retirement. They give me a buyout. I'm going to take Social Security, and at 62, the wife's going to continue to work. Notice how we always make the wife work on the show here. Sorry about that, ladies. And the wife's going to continue to work. I can get on her health insurance and that type of thing. And still in the world we live in today, overwhelmingly, the husbands have higher Social Security amounts than their spouses do, because a lot of times spouses had to leave the workforce to raise the children, that type of thing, and they were in lower paying jobs. Now, for some of the younger people, I'm 56, obviously we're seeing a lot of women that have been in the workforce for a very long time and certainly equalizing. But if we're looking at somebody that's 65, 70 right now, you really need to pay attention to, what your Social Security amounts are when you pass away. Is that the best option? And, does one take it at 62 and the other spouse wait until later to get a greater amount so that you're passing on a larger survivor benefit? And can the investments make up the difference for you not taking your Social Security right now?
And speaking of passing things on, Chris, number 12 on your list of common financial mistakes: not having the proper documents in place.
Exactly. We harp on our clients about having estate planning documents up to date, powers of attorney. If something happens to them and their children call us to get information, we need a financial power of attorney to do that. I know mom and dad are sick, but I can't tell you anything unless you are authorized for me to tell you. And same with your banks to make mortgage payments and whatnot. But having your wills in place, your trusts in place for those of you that need a trust. Is the house going to probate, or do you have a quick claim deed or a beneficiary deed, that type of thing as well?
Well, Chris, I think, started the program talking about how we all have some mistakes that we can look back on and say that we've made. A lot of times they do have to do with money. And a lot of times it was things that we didn't do. I look back and the things that I can say, well, I regret that. A lot of times it's that I didn't do that I did not take that trip when I had the opportunity, that I did not jump at that opportunity when I had it. And I think that we need to think about our money proactively. Sometimes we're going to look back and say, I could have done things differently. It's not necessarily a mistake. The mistake is not being proactive when we have that chance and that opportunity. And that's why we're talking about some of these common financial mistakes, because smart people learn from their own mistakes, Chris, but unfortunately, we don't really have that time or luxury in retirement. It can be pretty painful if we learn from experience and making our own mistakes in retirement. So talking about these so that hopefully people can avoid some of them. And the opportunity is to be proactive and get that plan put together. And Chris, you go through that process with savers and investors every day in your office.
We sure do, Peter. And, in 2018, my wife got a phone call that, kind of changed our outlook, and thankfully everything is okay. But, they found a tumor on her pancreas and had to have that removed. And, that was when she was 58 years old. And, in 2019, we took one hell of a trip to the country of Italy. And, that would have been a retirement trip. So, guys, we're all a phone call away from a life-changing event here. So, make sure you keep things in perspective and live every day and love every day as well. And I mean that from the bottom of my heart.
Well, let's also plan to continue enjoying the future, and let's make sure that our money is working effectively to help support us, our comfort, our confidence into and throughout our financial future, and that we have a plan in place. Chris McIntire can help you structure that plan, or if you've got one, you want to review it, get a second look at the plan. He does offer that on a complimentary, no cost, no obligation basis for radio show listeners, for podcast viewers. All you need to do is pick up the phone, give a call, be in touch, have a quick conversation over the phone, and then we can figure out if when and what time would be convenient to have that complimentary review in person in the office. Chris has several throughout Northwestern Ohio, or virtually for your comfort, safety, and confidence, however you prefer to do that, and convenience. 800-868-1194, the number to call. Similar reviews can easily go upwards of $1,000 to several thousands of dollars. Chris McIntire will look at the risks that you're paying. Chris McIntire will look at the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, help you run an investment analysis, and structure the written plan for retirement. Again, no cost, no obligation. All you need to do is pick up the phone and call. 800-868-1194. That's 800-868-1194. Chris, we always appreciate the guidance, perspective, and today shedding a little light on some of the common mistakes, so hopefully we can avoid them.
Yep. And been a pleasure talking about this, and we're all just human. So we all make mistakes, and don't beat yourself over it. We can help you get back on the right track though.
Well, give Chris a call. He's looking forward to hearing from you, helping any way he can, giving you that direction in your planning. 800-868-1194. We'll look forward to speaking with you soon.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.